Hello, welcome back to our second lecture video. And in this video, I want to look at how we prepare income statements using both variable and absorption costing. This video really should be kind of a review. The reason why is we're going to pull in the idea of the contribution formatted income statement, and we're going to see how we handle or how we prepare the income statement under the various costing methods using that modified, I'll say, contribution formatted income statement. So let's just go ahead and jump in. So we have an example here, and we're going to assume for a moment that the company, Harvey Company, has 20,000 units that were sold during the year at a price of $30 per unit, okay? We're going to assume right off the bat that we have no beginning inventory to worry about, okay? Now, we're going to compute net operating income using both absorption and variable costing. Now, I want to say this first, and then we'll see it in action. The net operating income will be different under each method. And the reason why, it's all in how we handle the fixed manufacturing overhead. So, first thing we're going to do is we're going to go ahead and we're going to put together the variable costing method. Okay? So notice what we have here, right? The contribution formatted income statement segregates, right, based on variable and fixed. When doing the contribution formatted income statement, we include all variable costs at the top. We get our contribution margin, then we get our fixed, or subtract out our total fixed costs, okay? So we're using the variable costing. We're using the contribution formatted income statement. So let's see what we have first. First thing we do is we have our sales, right? They tell us that the company sells 20,000 units. Not a problem. 20,000 times 30 bucks gives us $600,000. That's our sales for the period. Next, we subtract out all variable expenses. That's the variable cost of goods sold, as well as variable selling and administrative expenses. We subtract out our variable expenses, we end up at the contribution margin, then we subtract out our fixed expenses, okay? Notice the variable cost of goods sold, okay? Notice what we use, the 20,000 units, because that's what we sell, but notice the price that we use. We use $10, right? That $10 is the variable manufacturing cost, okay? Very important that you recognize we're using the $10, not the $16. That $16 that we saw in the previous video, that was the absorption costing manufacturing unit price, okay? We're working with the variable costing, so we have to use the variable manufacturing cost only. Okay, we get $200,000. Well, that's easy. 10 times 20,000 units should give us $20,000 of what? Variable cost of goods sold. Then we subtract out variable selling and administrative expenses. So I'm hoping you're thinking right now, well, wait a minute, why are we doing variable selling and administrative expenses when selling and administrative expenses are always part of the period cost? They're never part of the product cost. And I would say that's right. But then I would also say, but remember, we're doing the contribution formatted income statement. When we do the contribution formatted income statement, we're not worried about product cost and period cost. We're worried about cost behavior. Are they variable? Are they fixed? Okay. And if you think back to the definition of a contribution margin says we take our sales and we subtract out all variable expenses. all variable expenses. Doesn't matter if it's a product cost or a period cost. If it's variable and we're doing the contribution formatted income statement, we're subtracting out our variable selling and administrative expenses. Okay? They tell us that the variable selling and administrative expenses is $3 per unit times 20,000, gives us 60 grand. Okay? Subtract total variable from the sales, we get a contribution margin of 340,000. Now we subtract the fixed costs, right? Remember, I do not care if it's a product or a period cost. I care, because I'm doing variable costing, I care if it's variable or if it's fixed. So, under the variable costing method, using that contribution formatted income statement, we subtract out the fixed MOH, we subtract out the fixed selling and administrative expenses, we end up with net operating income of 90 grand, okay? Notice the two most important things on this slide that they're telling you. Number one, since we're doing variable costing, we got to use the contribution format income statement. That's number one. Number two, whenever you're trying to calculate the variable cost of goods sold, you got to use the variable manufacturing cost only. Third thing they're pointing out to us is that all fixed manufacturing overhead cost is expensed, right? Meaning it's expensed when it's incurred. It doesn't show up on the balance sheet. It doesn't become part of the product cost. Because we're doing variable, it's fixed. It gets expensed when incurred. Okay? So now we're going to look at absorption costing. Now, this should be very, very, very familiar, right? Sales less cost of goods sold give us the gross margin. Subtract out all selling and administrative expenses. You get your net operating income. This absorption costing income statement does not care how costs behave. Are they variable or are they fixed? We don't care. What we care about is it a product cost or a period cost? Okay? So notice what we have here. Sales, 600,000. That's always going to be the same, right? Because regardless of the method we use, the number of units we sell are always going to be the same. The selling price is always going to be the same. So 200,000 times 30 bucks gives us $600,000. We now subtract out the total cost of goods sold. Okay? Think back to the prior video. We said the unit product cost under the absorption method is $16. It's $6 higher than it is under the variable costing method. Why? Because of how we handle the fixed manufacturing overhead. Under the absorption costing method, all product cost, DM, DL, variable MOH, and fixed MOH all become part of the product cost. So notice we take the cost of goods sold, we say 20,000 times our unit product cost under the absorption method, which is $16, we get $320,000 of cost of goods sold. Gross margin then ends up being $280,000. Next, we subtract out our period cost, meaning our selling and our administrative expenses. Guess what? We don't care if it's variable selling or fixed selling. Because we're doing absorption costing, we care about product and period costs. So we're taking total selling expenses, both variable and fixed. We're taking total administrative expenses, both variable and fixed. Notice what our net operating income is, $120,000. Okay? That's a difference, right? Before, when we used variable costing, we saw $90,000. Now we're seeing net operating income of $120,000. Net operating income under the absorption method is much higher than it is under variable costing. It's $30,000 different. Why? It's because of the fixed manufacturing overhead, right? Under the variable portion, we expense total fixed manufacturing overhead cost as it's incurred. So we expense the total fixed MOH of $150,000. Under absorption costing, we say, no. We don't expense total fixed MOH. Under absorption costing, fixed manufacturing overhead becomes part of the unit product cost. That's why we have the higher unit product cost under the absorption method. So what that means is we have 5,000 units, right, times $6. That gives us the $30,000 difference, right? Basically what this is saying is it's saying that, hey, you have some fixed manufacturing overhead costs that are part of your product cost. You did not recognize it yet. That fixed MOH is still sitting on your balance sheet. Under absorption costing, that MOH that fixed MOH will be recognized when we sell those units. Okay, so that's the difference between the two. Now, when we come back in our next video, we're going to see how do we reconcile variable cost and absorption costs. Keep in mind the two main differences when putting together the income statements, right, under the variable and the absorption. Variable costing method says, number one, you use the variable manufacturing cost. Number two, you got to use a contribution formatted income statement. Number three, fixed manufacturing overhead expenses are treated as a period cost. That means that we expense those. We expense all the total fixed manufacturing overhead cost. Absorption costing says, okay, we're going to use that traditional income statement. We're going to use our unit product cost under absorption method. We're only going to recognize the cost of the units that we sell, which is 20,000 times 16 gives us 320, okay? That means that floating out there somewhere, specifically floating out there on our balance sheet, is fixed manufacturing overhead that absorption costing says, we're not going to recognize this until we sell that unit. Absorption says, I don't care when you sell it, it's fixed MOH, expense it in the period in which it incurs, okay? When we come back, we're going to see an example, or we're going to discuss and also see an example of how we prepare or how we reconcile the difference between variable costing, net operating income, and absorption costing, net operating income. And again, we're going to explain why the two amounts different. Why? We already explained it. We'll explain it again in video 3. But remember, the difference is because of how we treat fixed manufacturing overhead versus the two costing methods. So turn back in for that exciting video.